So you remember a couple of weeks ago when that family office hedge fund, Archegos Capital, got absolutely bodied by some banks because they were margin called, and then this sent half a dozen or so stocks tumbling downwards because Archegos Capital held large positions in those companies and no one was aware because of some kind of fuzzy guidelines at the SEC. Well, this has kind of created an opportunity, and one of those companies was hit particularly hard, and that is ViacomCBS. Now, I actually did a fundamental analysis of this and gave it a, hey, you're pretty cute rating of a 7 out of 10, and gave my price prediction. Well, this company has since gotten much, much more attractive. It's no longer just cute. So much so that I have purchased $5,000 worth of this, and I plan to buy more after I kind of just see where the next few weeks go. So as an overview here of what exactly happened, again, Archegos Capital, they were margin called, they held a huge position in Viacom. As a result, Viacom stock went from $100 down to $45 immediately. I did an analysis on it at 45 bucks, and I was like, this thing's pretty darn good. And the important thing to remember is nothing changed in Viacom for it to go from $100 to $45. None of their fundamentals changed. Nothing. This was simply a wrong place at the wrong time for Viacom. Now, Viacom has some good and some bad to it. Mostly good, in my opinion, but of course, do your own due diligence. I can't even talk. Due diligence as well. I'm not a financial advisor. People might call me Stonk Jesus, but I'm not really your stock messiah. Now let's start with the bads. It's a big leader in a dying industry, which is cable, which is definitely a concern. We want to highlight all the concerns here in any investment because there's always pros and cons. Also, its earnings aren't the most stable. However, they do trend upwards. We'll talk more about that later. And they have more debt than I would particularly like to see. But it's good for so many reasons. So first off, despite being in a dying industry, they are the biggest. CBS is the most watched television station. Their Q4 ad revenue was actually up 4%, and their Q4 affiliate revenue was actually up 13%. So their revenues were actually increasing with the most recent quarterly results, and they're taking a really smart transition from traditional cable, dealing with the cable cutters, to a Netflix style subscription. They're being really smart about it. And they're doing this with their free with ad service, Pluto TV, that now has 12 million subscribers. But the smart part is that they're using this as a gateway to their new paid, kind of like Netflix type subscription, Paramount Plus, which is gaining steam right now. And then as an owner of huge stations like Nickelodeon and Comedy Central and tons of movies, they offer 30,000 episodes, 2,500 movies, live sporting events, and 24-hour news coverage on Paramount Plus. So they're just like hitting the ground running with this subscription service. I mean, we are basically turning into what exactly is cable again with all these different subscription services, and then eventually there's going to be bundles, but that's not what this video is about. But that's what's going to happen. With Paramount Plus, they have at least 8 million subscribers as of now, and it seems to be growing fast. Also, it's a media giant with multiple brand names that people know and love, and it's just easier for someone to transition to something that they're already familiar with. And right now, the stock is cheap. But before we get into price predictions, let's quickly look at their financials. Also, if you want to start receiving buy alerts as soon as I buy a stock or a crypto, you can join as a YouTube channel member, level 2 and above, and this will give you complete Discord access, including my buy alerts. And this is something that I'm really excited about and we just started doing recently. So if you're interested, go ahead and sign up for that. But diving into the financials, I put together this spreadsheet so we can kind of analyze how healthy the company is. So first, the price to earnings ratio. I look for between 4 and 15. I consider that great. The ratio here, as of right now, is just over 10. So the Pde ratio, you can kind of think of this as the amount of years it would take to earn 100% on your investment purely with earnings. So no increase in the stock price whatsoever, so a 10. A price to book ratio, I look for this to be between 0.6 and 1.5. We're at 2.5, so it's not perfect there. Debt to equity, I look for this to be around 1, but this can vary industry to industry. Theirs is 1.6, so again, it's okay. The current ratio, which as you can see shows the firm's ability to pay off short-term obligations, is 1.38. I want this over 1.5 ideally. The market cap, I just look for companies that are over $100 million. And then the dividend yield, yield, I look for that to be between 2% and 7%, and theirs is at 2.44%. That's pretty good, and that's actually increased because their stock price has gone down in the last couple of weeks. So now let's go into my price target for them, and this is the most exciting part, and this is where the decline in the stock price really makes a huge difference. Because when I did this analysis, the stock prices were at around 45 bucks, and I was like, this is a pretty good buy at 45 bucks, and it has slowly gone down since then to the point where it's like, I don't know how much lower this could possibly go because it's already in value territory at where it sits right now. If it goes much lower, then it's just kind of like mind-blowingly value territory. So in order to figure out where the share price may be in 5 years, I look at the previous 5 years and then I base a projection off of some conservative numbers that we can get behind. So let me explain the process here. So the earnings per share growth in the last 5 years was 39.5% for ViacomCBS. Annualized, that comes out to 6.7%. Now, like I mentioned earlier, this is pretty shaky though. Some years they have very high earnings, some years very low earnings, but it is increasing over time. It's just not a nice stairway to heaven, stepping upwards trend, which is ideal, but it is trending upwards. So because it's not super consistent, I'm going to project the earnings per share growth at a conservative 4%. This would give us $4.97 in earnings per share at the end of the year 2025, and this would equate to $3.06 billion in earnings in 2025. Now, if we look at my projections here, this is the old projection when the price was at $45. And we take a historical Pde here of 15.75. This is the average Pde of ViacomCBS over its entire lifespan. The average is 15.75. Right now, we are 30% lower than that at 10. So that tells you something in itself. So at a Pde of 15.75, that gives us a market cap of just over $48 billion and a price target of $78.24 in 5 years. Now, this price target is only based on earnings. If they have some kind of superior results with their Paramount Plus, or valuations start changing and we start getting like a more techie valuation, the price could dramatically change. We're going to talk about that in a second. But this is a very conservative $78.24 based only on earnings. So a return in 5 years at a purchase right now based on a $45 share price, which is cheaper because this is the old valuation, that would give us a return of 73.33% annualized at 11.63%. But then the share price went down by more than 10% since then. So it's a much better buy right now. This is the classic buying the dip, buying when others are fearful. This is when you really make money. So with the same market cap of just over $48 billion, same price target, but the current share price is lower because now we're at just under $40. This increases our return over 5 years from 73% to 98%. So if a couple weeks back you watched my video and you're like, hey, that seems like a pretty good deal, it's a way better deal now. The annualized rate of return, still with this conservative analysis, is 14.75%. Now you might be thinking, and I get criticisms like this because I'm always very conservative, you might be thinking, well, I don't think the valuation is going to be the same in the future because they're kind of going to the Netflix strategy. So we need a higher Pde than their classic like cable established industry Pde. So I got you. I got your back here. So let's do a tech Pde of 20. A price to earnings of 20. This is double where they're at right now, and what would that be? 30% higher than their historical average. So this would give them a market cap of $61 billion in 2025, again using those same projected earnings with the 4% increase in earnings per share. Again, that could increase as well. It could be an 8% increase in earnings per share, and that would make the valuation way, way higher than it is right now, but we're trying to be realistic here. So with the old price per share, we have the same price target of $99.40, a return over 5 years of 120%, annualized at 17.08%. With this new lower share price, we have a return over 5 years of 152.6%, annualized at 20%. This is like the median kind of tech Pde here, 20% annualized returns on a purchase right now just based on earnings growth. And now I know some people are even going to say a Pde of 20 is nothing because we're in like a crazy hot stock period right now. And so there's people who are like this, they're competing with Netflix, they should be valued like Netflix. So I've done that as well. I don't think that we should base it off of this. So this is just kind of like just purely for entertainment purposes. I do not think we should value this company with the same valuation as Netflix, but we're going to just do it just for the sake of it. So Netflix has a PDE of 89.74. With the same PDE in 5 years, ViacomCBS would have a market cap of $274 billion. I mean, we can see how crazy of a jump from 61. This is why valuations are so insane as to how much a company is worth based on valuations. We can see just a change in PDE from 20 to 80 takes this company's value from $61 billion to $274 billion, and the earnings don't change. That's why it's insane. So that gives us a price target of $445, a return over 5 years of over 1,000%, and an annualized return of 62%. Now, again, I do not think we should base it off of that, but I just know certain people are going to be like, if they're competing with Netflix, you should value it like Netflix. So, there you go to those people. But overall, when I was looking at these numbers, to see the annualized rate of return at a fairly conservative estimate of 20%, because we're at rock bottom right now. We're in a situation where the company dropped because of bad press, but in the perfect situation where they didn't do anything wrong to get the bad press. It was just simply a bad actor, or I guess not even a bad actor, just someone who was margin called and maybe was being a little bit too reckless, that held too many of their shares and caused the price to go down. It has nothing to do with their fundamentals. This is like the perfect, looking for opportunities like that is the perfect kind of buy the dip opportunity on a piece of bad press that doesn't actually hurt the company's performance. Like no one who watches Paramount Plus is going to care that their share price dropped by 60%. No one's going to care. But as an investor, that's where the opportunities lie. So that's why I put some money into this. My strategy here, I bought a small amount up front, and then I'm just going to kind of wait and see where this goes, because there's a potential for it to go down slightly, but in the long term, it is just not going to stay this low. I'm very confident that it's not going to stay in that long term. Again, I don't really ever try to do short-term swings. I'm not trying to guess what's going to happen next week, but if I see the fundamentals work out to where this is a potential hold for a few years, I think this is a good, 2 to 4 year hold where you'll see a solid return. It just, in my opinion, seems like a solid buy for the portfolio, 2 to 4 years. Of course, do your own due diligence. Grab some free stocks with Webull with the link in the description below. Grab some crypto with the link in the description below. I'd like to thank you for watching, and I hope you have a profitable day.